Chapter 1, Managerial Accounting Cost Concepts. Well, now we are into the managerial accounting mode, and that means that financial accounting is over, and we'll be talking instead about accounting for managers within businesses. And this is a totally different discipline, actually. There are professors who do nothing but this as their expertise. In fact, the Citadel's expert is Dr. Foster. She teaches the upper-level managerial accounting courses. And managerial accountants do much different things than financial accountants do. So, Chapter 1 is the basic concepts. So let's look at some of managerial accounting. The areas of comparison, well, for managerial accountants, it's mostly managers. For financial accountants, it is mostly stockholders, lenders, customers. The report format, this is always exciting for students. It's flexible in managerial accounting, whereas we've got GAAP that we have to use in financial accounting. The purpose of the reports is whatever management needs in managerial accounting. But this is basically, in financial accounting, talking about past performance. The information for financial accounting is very objective. It's dollars. It's prepared periodically. When we go into the managerial accounting area, this new topic, it's very objective. Sometimes it's non-financial information. Sometimes it's dollars, and it's prepared as needed. So I think the biggest key that we have here is the fact that in financial accounting, everything is based on GAAP. It's kind of rigid. In managerial accounting, it's whatever the managers need. So why do we care about the cost of a product? Well, there's lots of reasons for that. If you're a manufacturer or if you sell in the retail area, you've got to know what your product costs so you know what you can charge, and so you can find out what profits you're going to make and whether or not you can even afford to work with this product. Doesn't matter if that product is a lawyer with handling someone's divorce, or if it's manufacturing a Boeing jet, or if it's Walmart selling toothpaste. So costs are also known as expenses. We're sort of changing the term now because this is sometimes called cost accounting. So costs are expenses, and I always like to say that a dollar saved is more valuable than a dollar earned. And when I ask this question in a face-to-face class, most students get that concept because the idea is that when you earn a dollar, you have to spend money to make it. But if you save a dollar, that goes straight to the bottom line and increases your net income. Another concept I like to talk about, because in cost accounting we'll be talking about budgeting, is that a budget will tell a company what it can't afford to buy, but it doesn't keep you from buying it. So a lot of companies have budgets, but they don't adhere to their budgets, and we will be talking about budgets in this cost accounting or managerial accounting course. Cost recognition. So one of the things that we're going to be talking about is the fact that a single cost can be classified in lots and lots of different ways. It helps us to be able to trace costs to products, to figure out how many we need to sell, to break even. It's going to help us whenever we need to identify activities that add value and activities that we should drop because they don't add value. And finally, it will help us when we start to prepare the financial statements. A single cost we can recognize and measure our lots of ways to classify it. And the more you slice and dice the costs, the better information you have and the better decisions you can make. So if you can take a business and figure out whether their costs are product or period, direct or indirect, value-adding, non-value-adding, variable or fixed, if you can figure out these categories, then you're doing a whole lot better as far as being able to control your costs. So here we have it. We'll be talking about these extensively throughout the semester. Cost traceability says, is it directly related to our product or is it indirect and hard to trace? So as an example, when Boeing manufactures an aircraft, the chairs that go inside are direct costs. But the cost of the janitor to clean up is still a cost of manufacturing that jet, but it's indirect. You can't really trace it to one jet. Cost behavior is fixed versus variable, and a fixed cost is one that doesn't change regardless of how much you produce, but a variable cost varies. The more you produce, the more the costs are. Value-adding attributes are quite interesting for a lot of students. Value-adding versus non-value-adding costs. As determined by the consumer, a value-adding cost is one that they would pay more for, but a non-value-adding cost is not. So you would probably not pay more for an iPhone if you found that it was going to result in all the upper-level managers receiving a jet as part of their compensation package. But you probably would pay, and you would find it value-adding, if iPhones suddenly came out with completely 100% non-breakable screens. This is coming from me, who breaks screens often. Finally, cost classifications. Product versus period. A product cost is one associated with the product that we're selling or manufacturing. A period cost is an expense that goes straight to the income statement. So as an example, for Apple, the cost of the product is the cost that they pay for the iPhones they sell. A period cost, however, would be something like legal fees that they have to pay to defend some of their situations with customers, or maybe Google, who sues them. Okay, the threes. I like to call this the threes. We're going to look at manufacturing costs as materials, labor, and overhead. Those are the three types of costs. We'll find that materials and labor are direct, overhead is indirect. And we're going to categorize our inventory costs as materials inventory, work in process inventory, and finished goods inventory. So the three elements of the product cost, let's go a little bit more in details with them. Okay? We look at So let's look at the three elements of a product cost. We have direct materials, direct labor, and overhead. So direct materials are defined as a material that's easy to trace to the product. Direct labor is labor costs that are easy to trace to the product. Is a cost of a product that is inconvenient costs and difficult, and they are not expensive easy to trace. So let's take an example of McDonald's. They probably don't know exactly the cost of the salt in one of their hamburgers, but I'm sure they know the cost of the hamburger meat. Property taxes are a cost of a product, depreciation, equipment, insurance, rent. These are all considered overhead costs. Let's go to this classification of costs. Period costs are usually known as operating expenses. They're not inventory, they're not a product cost. And the other type is a product cost. It's an inventoriable cost. It includes the materials, labor, and overhead. And on the income statement, when they get there, they're categorized as cost of goods sold. On the balance sheet, they're inventory. So what's an example of a period cost? That would probably be period cost. Let's look at the Citadel as far as a period cost. That would probably be the cost of the individuals at the library. But a product cost at the Citadel would be the faculty salaries. If we look in manufacturing, a period cost would be the cost of advertising for Boeing. It's not part of their inventory, it's not part of the product. Whereas a product cost is inventory. That would be the costs of materials, labor, and overhead related to manufacturing a jet. Another division of our costs or our expenses are prime versus conversion costs. A prime cost is your materials and labor. Those are the most important. They're also direct costs. And a conversion cost is the cost to convert the materials into a product, and those are direct labor costs and overhead costs. So let's look at all of these classifications in one big bunch. So under financial reporting, we have product and period. And when we start looking at this under the financial area as well as the managerial area, the product costs can be materials, labor, and overhead. And materials and labor are prime, labor and overhead are conversion costs, and period costs go straight into our operating expenses. And you should remember sales minus cost of goods sold equal gross margin minus operating expenses equals net income. If that was something you don't remember very well, go back maybe and review, I think it's chapter 4 of your BODM 211 course. Cost behavior. We're going to do a full chapter on cost behavior. A variable cost is one that changes in proportion to productivity. A fixed cost is one that stays the same. So at McDonald's, a fixed cost would be the cost of the rent on the building. A variable cost would be the cost of the meat for a hamburger. No matter how many hamburgers you sell, the rent stays the same. If you don't sell any hamburgers, though, there are no costs related to the meat of the hamburger. Value adding versus non-value adding. Some of this is subjective. Lots of times it's from the customer's perspective. But a value-adding cost is one that adds value to the product itself, increases its market value, and a non-value-adding cost is not necessarily one that's useless or unnecessary, but it doesn't increase the market value. So maybe the accounting department, human resources, the legal department, areas such as this are generally considered non-value adding. You can't eliminate them, but usually you like to reduce them and you like to increase value-adding costs. Examples, okay? Let's look at the manufacturer of candy. Sugar is a direct cost. It's variable because it will increase the more sugar, the more candy you make. It's value-adding because customers would like to pay more for a better sugar product. And it is a product cost, direct materials. Let's come down here to something like the accountant's salary. It does not trace to the product. It is fixed. It is non-value adding, and it's a period cost. Manufacturing cost flow is the other three items that we want to look at. Usually on a manufacturing company, there are three types of inventory: materials, WIP, and finished goods. Sometimes they're called direct materials. Sometimes it's called manufacturing work in process. But these are the different types. So when we're dealing with manufacturing, we're going to find it's a little more complicated. In your financial accounting classes, normally you always work with service industry, or you work with the commission-based salesperson. Retail sometimes when we do inventory, but we're going to deal with manufacturing, which is a little more complicated. Manufacturing has three types of inventory on the balance sheet because you've got direct materials and you've got work in process, which is partially finished goods, and you also have finished goods. Okay, materials, WIP, and finished goods. Sorry, sometimes whenever I'm recording these videos, you will hear a pause as I have an interruption or need to take a quick break. So my apologies if there's some duplication here. Let's look at how we figure out how much it costs to make one. It's called the product unit cost. So let's say that we have, let's look at we can look at a car manufacturer, and they take the materials and then they add together the labor and the overhead that they've spent maybe in a month, and they'll divide that by the number of cars they make, and they'll figure out how much it costs to make one. So it's a really, really simple formula. Direct materials plus direct labor plus overhead, and that's the cost for one if you divide it by the number of units produced. We're going to use something called normal costing because overhead usually has to be estimated, and we're going to estimate this using a predetermined overhead rate. We'll know what the materials are that go into our product. We will know the labor. We're going to have to estimate our overhead because you really can't wait to find out how much your overhead is. So let's think of a quick example, and that's this. What if a company is located in, let's say, Minnesota? Their electric bill is going to be higher in the winter. The utility bill, the electricity, is considered to be overhead. Does that mean that if you buy one of their products that was manufactured in December, it's going to cost more than in the month of June? And of course we all know that's crazy. So what they do is they estimate the total amount of overhead, and we're going to study in Chapter 2 something called a predetermined overhead rate. And we'll add together the actual cost of the materials and labor. We will estimate the overhead by applying it using a predetermined overhead rate, and we'll figure out how much it costs for the total product. We're now on the last concept of Chapter 1, and that is the ethics. You've had a lot of ethics if you're a civil student, particularly if you're a cadet. Standards of ethical conduct mean that we have to look at the constituents that we work with. Accountants, whether they're management or financial accountants. Accountants have a lot of private information, and we also have a lot of responsibility that determines whether the company is profitable or not. And so whenever we look at the ethical conduct of a company, we have to be very conscientious to make sure that everything stays objective and that people don't act in a biased manner. So the standards are that we should be competent, maintain our confidentiality, our integrity, and our credibility. So confidentiality means we don't talk about confidential information. Managerial accountants know what the CEO makes. They know whose wages have been garnished for back child support. They know about the lawsuits of the company because they've seen the bills coming through. And you have to ensure that you don't take advantage of it. An example would be insider trading. Other standards of ethical conduct include integrity, which means you want to avoid conflicts of interest. You don't want to be prejudiced. So let's say that you have a good friend that works in another division and you know that they really could use a bonus, and so you can think about ways that you could maybe provide more information so that that division looks better, so that your friend gets that bonus. That would be an activity that would discredit the profession. Credibility also means that you remain fair and objective, that you don't disclose information improperly, but that you put everything out there so that users can understand the material that they're looking at. And you also want to make sure that you have full disclosure on everything that you deal with. So there's lots of ethics related to working in the management accounting area. For a quick review, managerial versus financial accounting we've discussed. We've talked about the different types of ways we can slice and dice costs. We've learned that costs are the same as expenses. We've talked about the 3 product costs: materials, labor, and overhead right here. We've talked about the 3 types of inventory: materials, WIP, and finished goods. We didn't really go over this, but it's a part of the chapter. It's something from last year that this all keys into, and that is sales minus cost of goods sold equals gross margin minus operating expense equals net income. So cost of goods sold is a product cost. Operating expenses are a period cost. We talked about the fact that we will use normal costing where our overhead is estimated. Finally, we talked about the Managerial Accounting Code of Ethics. Chapter 1 is really a lot of definitions, a lot of new material, but just a lot of what we might call terminology. And I hope you'll take some time to go back and understand and use this terminology. There's some flashcards provided in the ebook that will be helpful, but you should be ready by now to do your homework as well as to take the quiz that we have in Chapter 1. As a quick reminder, Chapter 2 is also being covered in the this week's module, so don't forget that part. Best of luck.